Okay, so the name macro, the prefix macro means large scale. So we're trying to talk about the whole economy at one time. Right? So in your previous lecture, you heard about microeconomics, where you talk about the problems facing a firm or a consumer or an industry or a market. This is an attempt to be more comprehensive. And if we ask sort of how's the economy as a whole doing, we're either talking about business cycles, right? How is it right now compared to the trend it's been on over the decades? And that's been the traditional focus of macroeconomics, or that's where it began. Back in the 19th century, they started having debates about why are we seeing mass unemployment? Why was business booming last year, and this year it's really in the dumps? But in recent decades, economists have become convinced that, it's really more important to think about the long-run performance of the economy and about why some economies grow faster than others and why some economies are richer than others. And so that's kind of under the rubric of macroeconomics, too. And it makes a lot of sense. So Robert Lucas, who got a Nobel Prize for his contributions to business cycle theory, turned away from it after he sort of sat down and on the back of an envelope figured out that the gain from eliminating business cycles, which are these little perturbations around the growth trend of the economy, are really pretty small compared to tipping the growth rate up by 0.5%. So if we could figure out how to do that, we would benefit the public a lot more than just figuring out how to moderate business cycles. I'll show you some evidence on the relative size of those two things in a second. Next slide. All right, so the basic measure we have of how the economy is doing as a whole is the gross domestic product. There are other measures, but let's not waste time talking about the distinctions between gross domestic product, gross national product, national income. They all pretty much move together. So it's a measure, it intends to be a measure of how much stuff we're producing, and it's per year, of course. It's a flow. It's how much income the economy is generating. And sometimes I will say income, and sometimes I will say output. Same thing. Output is what generates income. Right? When you sell your output, that's when you have your income. And we're only counting sold output. So it's really two sides of the same transaction, the output and the income. Now, it's limited to final goods and services. So what does that mean? It means we're not counting every business-to-business transactions. We're basically counting retail transactions or sales of finally finished goods to businesses or to the government. But we're excluding used car markets. We're excluding financial markets because those aren't goods and services. We're counting domestically produced goods and services, so we're not counting imported goods. And what's the last one? Oh, yeah. So in order to avoid double counting, we don't want to count the sale of, say, ingredients to a restaurant and then count the sale of the meals at the restaurant, because then we'd be counting the same steak twice. So it's just final goods and services. And in a way, then, you might say it underemphasizes the fact that there's more to the economy than just retail sales. Focusing on GDP can sometimes give that illusion to people that all that matters is how retail sales are going, when, of course, a lot of the economy is all the stages of production leading up to retail sales. Next slide. This picture from the text is a simple version of tracing output through stages of production. But if you just measure the value of the final output, you do measure the value being added at each earlier stage of production. Right? So you've got the value of the wheat that the farmer produces, and then add how much more the flour is sold for than the wheat was sold for. That's the miller's value added. And then how much more the bread sells for than the ingredients, the flour that went into it. That's the value added by the baker. And then the difference between the retail price and the wholesale price that the grocery paid to the baker, that's their value added. So it all adds up to the price of the bread by construction. So in that way, the retail sales do capture the previous value added, and to count them both would be double counting. I believe it's the Commerce Department has recently started a series called Gross Output, in which they count things at earlier stages of production too. And then you can talk about what share of the economy is the sale of final output. And clearly, if you look at employment, most people are not employed in retail. Right? So there's a lot of economic activity that's not on the retail level. But GDP, by measuring final output, does reflect the value that's added at earlier stages. Now you can look at it, there are two ways to add up GDP. You can look at it by what's called the expenditure approach, which is to break it down by who the goods are being sold to. So there's the consumption share, that's right, consumers buying final goods and services. Gross private investment, that is business firms buying staplers, computers, paper. So the whole TV series, The Office, was about sales of paper to other businesses, not GDP transactions. And government purchases. Now, when we measure government's contribution to gross domestic product, we're only counting their purchases of goods and services, not every check they write, right? Because transfer payments are not purchases of goods and services. So like Social Security checks are not counted here. We do count the Social Security recipient's purchases of goods and services. We wouldn't want to also count the Social Security check. That would be double counting. So it's only government purchases of goods and services, this table, for example. And net exports, right? We produce stuff that's sold to foreigners. That's part of our output. And it says net because imports are stuff that is not being produced here. So we're not counting imports. Now, this doesn't mean that the more imports we have, the poorer we are. The imports are part of consumption, so excluding them from just counting net exports is a way of avoiding double counting. It's not a way of avoiding counting them. But it's sometimes the fact that we're counting net exports in order to avoid double counting sometimes gives people the illusion that, oh, it would be better if we didn't have imports because then GDP would go up. No, we'd have less income. If we were buying fewer imports, it's probably because we had less income. The other way to count it up is to count the factor payments. That is, as in the case of the bread we just looked at, the money that was spent on the final good is doled out to businesses, and then businesses in turn pay it out excuse me, to the people providing the inputs. So there are labor inputs, so there's employee compensation, that's the biggest share. We'll see the shares in a second. There's rental payments to owners of land and machines. There's interest, right, paid out by businesses. There are indirect business taxes. And what's left over is counted as profit, so it all adds up to the price of the final good. So we can add up GDP either way. They'd better be consistent. But the fact that they add up both ways sort of is an accounting identity. What it doesn't tell you is sort of where is the output coming from. And I think it's important to think in causal terms that producing more stuff is the source of greater incomes rather than more spending is the source of having more stuff. The ability to buy stuff requires that you have the stuff to buy. Right? So output is the source of higher incomes. So if you want people to have higher incomes, you have to produce more. You have to encourage more production. So here are the components of GDP for the US, and this is from the Gortney et al. Textbook. So personal consumption is the biggest share of expenditures, and so you sometimes see it reported in the press that consumer spending is 70% of the economy. Well, it's 70% of final goods and service transactions, but those aren't all the activity in the economy. And in the other way, in the resource cost approach, it's wages and salaries are the biggest share. In fact, in the years they looked at here, this is kind of surprising, the little footnote, rental income was negligible. So when business firms own their own capital or own their own land rather than renting it, it kind of disappears. Next slide. But it's important. So where are we right now? I mean, 2 weeks ago we got this news from the Bureau of Economic Analysis. They revised their previous estimate of first quarter 2014 GDP. All right, so this is the sort of press release that I hope you can now make more sense out of. Output of goods and services, real gross domestic product, I'll talk about the distinction between real and nominal in a minute, declined by 1% in the first quarter compared to what it was at the end of the previous quarter. All right, so if that continues, that would be bad. That would be returning into a recession. Typically, a recession is defined as 2 or more quarters of declining real output. There's a whole bunch of criterion, but that's the most important one. But notice that previously they had announced that real GDP had increased slightly, 0.1%. But now they have updated measures of some of the components that go into it. And how did it change compared to the last quarter of 2013? Decreases in private inventory investment, decreases in exports, non-residential and fixed investment, state and local government spending, residential fixed investment. Right? So those are coming out of that investment slice of the expenditures, and local government, not federal spending, though that keeps rising. Okay, so this is the sort of thing that we should worry about if we want to avoid going back into recession.